So-called Trump trades have been driving the markets as speculation grows around possible tax cuts under President-elect Donald Trump. Of course, an impending trade war with China, or threatened trade war, is hanging over some sectors of the market. But we've also got the promise of deregulation in the financial and energy sectors. Our guest says he takes a value-based approach to investing. He has dug out some sectors and stocks that could be affected by these policies. We're joined first by Mike Vinokur, portfolio manager at MV Wealth Partners with IA Private Wealth. Great to see you.
Thank you for having me.
Just to kick off, I mean, campaign promises are one thing, and we know that there's always delay before measures can be implemented.
Yeah, and the measures that were promised may be watered down by the time they get through Congress, Senate, and into law. And then you never know about the timing, which then could delay the actual effect of whatever is enacted whenever it does get enacted.
He's talked about freezing or leaving in place big tax cuts that he put in his previous term. Is that a given that he'll be able to do it?
I think so. The corporate rate, I think, was brought down under his reign from whatever it was, 35% all the way down to 21. 21 is a fairly low corporate tax rate compared to many jurisdictions around the world. So I think that that staying as it is for a given number of years is probably a good bet.
These tariffs, if they come in, could be hard, obviously, on companies that bring in a lot of stuff from China. For example, dollar stores, Dollar Tree.
Yeah, those, I think, could get really hit because if you think about it, the average item that they sell is already selling at a very low price. And so the margin embedded per dollar of revenue is not huge. Now you impose another 20, 30, 40% on the cost of that item. And all of a sudden, I just don't know whether companies like a Dollar Tree or Dollar General can absorb it and not increase the cost to the consumer, or they're going to have to pass on the cost to the consumer, which will be inflationary.
It's interesting that we've seen governments around the world falling amid inflation. The public hate it, obviously. And so presumably the Republicans will be anxious to avoid things that will stoke inflation.
Yes, but I think Trump is a negotiator. He likes to make a deal. In fact, I think he had a book called The Art of the Deal, right? It's all about pounding his chest and being able to say, hey, I was able to make a deal. So I'd like to believe that at the end of the day, what he really wants to do is he really wants more fair trade as opposed to enacting tariffs and putting up trade barriers, because we know from experience that that doesn't serve anybody any good. And all it does do potentially is have less efficient producers within your own domestic country, sell at a higher price, but that doesn't benefit the populace.
With this move up in markets, and the TSX is not far off record highs, you've got a fair amount of cash in your portfolios?
Yeah, we actually have probably one of the highest levels of cash in our equity models that we've had in 2-3 years. And we took advantage of this run-up, especially after the Trump win, to raise cash. We think that market's gone a little bit ahead of itself, and there's a little bit too much euphoria of what may or may not happen. And I think that the euphoria is going to come down when people realize that, inauguration happens on January 20th. Whatever policies they're going to make will take some time to enact. Those changes will take time to transcend through the economy. But in the meantime, the consumer is still going to be on whatever trajectory they were, regardless of who got elected. And so the next quarterlies coming out in the next, call it 6 to 9 months, will display that truth until any of those changes that he wants to enact actually change whatever trajectory was going to happen.
Can you give us a ballpark level of cash in your portfolios?
It's about 35% in our equity model, on average. So it's a very high amount. We've been taking tons of profit off of securities that have really run up very quickly, in our opinion, and we're looking for a pullback. We wouldn't be surprised that the markets can pull back 5-10%. Would be a very good normal course correction. It would allow the steam to come out a little bit and for new buyers to come in. So we think that could be very healthy. And, cash today is not trash still. Even with the rate cuts, we're still getting 3.5% to 4% on our cash. So it's not like we're sitting there and not earning any money. But we're potentially, giving up some upside should we be wrong and this market just continues going higher.
You do see potentially big deregulation for the financial sector, and Citigroup is a stock you'd favor there.
So we like Citigroup regardless. If you look at Trump's campaign and their policies, they do favor deregulation in many industries. One such industry that has been mentioned is the financial services. We believe that what's going to happen there is that a lot more smaller banks are going to be able to merge, and that's going to potentially reduce the amount of financial institutions in the United States, which I think still number 4,500 or so. Hard for a Canadian to fathom, right? But we loved Citigroup. We have liked Citigroup for a very long time. The case for Citigroup, in our opinion, is not hard to imagine. It's got great management, great cash flow, great capital levels, and a tangible book value, meaning if they sold all of their assets today and we as shareholders got the money back somewhere in the $92 to $95 range, and the stock's trading at 70. So, this is one of the big franchises in the US, money-centered bank, great dividend, great brand, very good leadership, in our opinion. And so whether regulation changes happen or not, we think this is just a very cheap equity to own.
And you also like the so-called health management organizations in America, including Cigna, which is backing away from a merger, and investors seem happy to hear that.
Yes, and I think what's important to note is that Cigna, unlike Humana, deals in a very different market. And so we like the market that Cigna caters to, which is mostly corporate commercial clients. And also their capital stewardship has been unbelievable. If you look at the last 10 years or so, they have grown their earnings consistently by somewhere in the range of 12 to 14% a year. And they have now guided to unbelievably good numbers. We think the insurance industry in general, given where we are in the environment, is a great place to be. We like Cigna a lot. We think it's a very, very cheap stock, and we think it's got quite a bit of upside. And so we're happy with that holding.
Yeah, I kind of implied that it was a health management organization. I guess it is.
It is both. And so we don't like all the health management organizations.
Okay.
You have to be picky and choosy, even within that industry.
Yes.
Two of the ones that we hold today are Centene and Cigna, for much the same reasons in terms of balance sheet strength, capital stewardship, growth in their earnings and EBITDA, and the end clients that they serve.
Mike, always great hearing from you. Thank you very much indeed.
Pleasure to be here.
Mike Vinokur has been our guest portfolio manager.